Welcome to Mining Over Canada. Join the Canadian Securities Exchange and our partners in a first-hand look into our country's vast mining landscape.
Hi, my name's Serin. I'm Director of Listings Development with the Canadian Securities Exchange. I'm joined today by Mark Smith-Windsor with Industrial Alliance Securities, and we're having a discussion as part of our Mining Over Canada initiative. We're speaking with Mark today as part of our Central Canada week that will be hosting a bunch of information around what's going on in Central Canada, but Mark has much more expertise than just Central Canada, so we'll be talking about investing in the mining space in general. Mark, thank you so much for taking the time to chat with us today.
Thanks for having me, Anna.
Why don't we start by telling us a little bit about yourself and your practice?
Yeah, so I'm an investment advisor. I've been in the business for 16 years now. I deal a lot in mining shares, but I also have a practice dealing with people's retirement accounts and diversified portfolios as well. So, being in Saskatoon, I chose to have a bit of a specialty, but also clients come to me with their general financial needs, and I assist them with that.
And so not all of your book is in the mining sector, but I know that you have quite a bit of experience in mining or investment in mining. Why don't we talk about that a little bit?
Yeah. So I've started doing mining investing in 2005, and at the time there was quite a nice bull market going on, and the shares were going up quite a bit, and it would be kind of one commodity would get hot, and then another commodity would get hot, and in Saskatchewan there was a big boom in potash, and so we got involved in a number of potash development companies that were ultimately sold at quite nice wins, and that got me interested in the space when I saw the type of leverage, if everything happens the way you want it to happen, the types of returns that can really add a lot of performance to your overall portfolio. And so and in Canada, we have, as you would know at the CSC, a very significant portion of the natural resource listings globally. And so when you're investing, you want to invest somewhere where you have a circle of competence and potentially have some sort of advantage that can allow you to earn returns. And whereas in California there's a kind of a Silicon Valley where people are really good at that. We're kind of like the Silicon Valley of mining in Canada. And so I chose to learn a lot about the area over the past 15 years, and it's fun. I really like dealing with the people involved and the opportunities and watching projects advance.
You know what? I think that's a really great point that you bring up, and I never thought about it that way. But we are the Silicon Valley in tech space is Canada in the mining space. The amount of professionals that know how to evaluate companies, how to invest in companies, and I think globally we're really this wonderful ecosystem globally for mining companies to come and go public and raise capital. And I think it's important for people to also know that the capital that's being raised in Canada for global projects also comes globally. There's lots of money that comes into Canadian funds and Canadian companies from all around the world. Wouldn't you say that's accurate?
Yeah, for sure. It's a financial center for this particular sector. And I think the smart money likes to follow what we're doing, because we have a lot of the leading companies and a lot of the leading entrepreneurs as well are based here.
And so one thing I think that's important to distinguish between investing in the mining sector, there's a bunch of different areas that you can invest. So let's break that down a little bit. And one thing I think people sometimes aren't fully aware of is that there's a very big difference between an exploration company and a mining company. Do you want to maybe touch on the differences there?
Yeah, so there's a continuum. So at the earliest stage is basically a company with a prospect. So they don't even have any resource. They basically have some land that they think may contain a resource. And the thing to keep in mind is the vast majority of prospects do not turn into mines. They, turn out to be, maybe uneconomic, or just there's various issues with them. As you move up the spectrum, you get into more development stage projects. These are companies that where they have a project, they have a resource where it's potential for it to be a mine, but it's not in production yet. And so what needs to happen is a lot of capital needs to be raised in order to either put it into production, or it needs to be sold to a more major company that may develop the asset. And then the advanced stage is where a company is actually in production. Now, the earlier stage you're investing, if it's at a grassroots where they haven't actually proven up an ore body yet, that's obviously riskier. So the earlier the stage, the more speculative it is, and the more risk involves. As the project moves along its development curve, it gets de-risked. And to the point where major companies, they like de-risked projects, and then it goes into production. It's all risky though, because it's dependent upon the commodity price, which you as a miner don't control. You're basically a price taker, and so I think it's all risky. And then the riskiest is the grassroots exploration.
So just to touch on the grassroots, because I think it's important for people to understand that grassroots projects and exploration projects are risky. And one of the main reasons is that you can have the greatest technical team in the world and the best historical data, and you might execute a flawless program, but you might not find anything. And so that's where the risk is really involved. And maybe you could just touch on the upside. And I guess the upside is really that the hope is that you find something and they would then they vend it to an operational company. Is that kind of the goal when investing in these grassroots projects?
Yeah, I mean, most projects that are put in production, if they're of size, are put in production by larger mining companies. And that's just because they have the technical teams and the financial capability to deal with all the things that go with being an operational company. And there's often cost overruns and things of that nature. And as a smaller junior company, you're less able to deal with it. So typically the goal is to develop a project to the point where a major company will take interest in it. In terms of sort of the upside, if you find a serious ore body, that will receive significant value in the market. And depending on where you are in the commodity cycle, you may mean more or less value. At a low point in the commodity cycle where we were a few years ago, even good results weren't really recognized. Now we're in a cycle that seems to have turned a little bit. Things are a lot better for the sector in general, and results seem to be getting recognized in the marketplace. So as an investor, in a grassroots project, your hope is that they get results that are positive and that they're recognized by the market. So just getting results is not enough. It also has to, cause a revaluation of the company in order for you to make money.
That brings up a question on that point. Do you think, and this is just your personal opinion, there's been this major switch from dealing with brokerage firms to the discount brokerage account? And the discount brokerage account is essentially that you are managing your own investments, you're making your own choices. I always strongly suggest that people come and speak to professionals such as yourselves. This is what you do every day, all day long, is evaluate projects and investment opportunities, and probably have a deeper understanding of the players that are involved in each project. So there's been this switch over to the discount brokerage side. How do you think that's affected the marketplace? Because if you don't have a strong technical background, I'm not quite sure how people would make their investment decisions in the mining sector since it's so technical.
Yeah, I think it's changed the industry quite a bit. there's a few things that have happened. Is the brokerage industry has moved from a transactional model to more of a wealth management fee-based model, and that's been a general trend in the brokerage industry. That's the area that the brokerage firms are going after, and so they're doing a little less of the mining activity, and at the same time, the discount brokers offer, what is appealing, a very low cost of transaction. And I think from the company's standpoint, they're now a lot more of the financings are being done directly by the companies, where they're going out and soliciting their investor list, and dealing with their fundraising needs that way. I think it'll change in a real bull market. That changes, and the brokerage industry gets a lot more interested in the resource area again. I think from an individual investor standpoint, I personally, if I'm investing in an area that I'm not comfortable with, like I don't have an expertise in, I seek advice, just because you can't know everything. And so I think if you're considering the area, one, I'd understand that it's risky, but I would be seeking, professional advice to make sure that, what you're considering is appropriate for your situation.
Well, I think you heard it here, everyone. If the expert will seek advice when they don't know, then everybody else should be. And I think it definitely is a testament to it. You get what you pay for, and having that kind of knowledge to make those decisions is, it's a big one. I really do suggest that people reach out to people such as yourselves who have this deeper understanding, as well as not just the technical side of things, but the investment side. And why don't we touch on that a little bit, because there's form and function, and this does span across every sector. But why don't we talk about kind of the investing and the structure of some of these companies, and let's touch on both the capital structure and the dilution effect of especially exploration, but mining in general.
Mm-hmm. So the thing to keep in mind about earlier stage resource companies is there's no cash flow coming into the company. So they're on a constant needing additional cash to fund their operations. So one thing to think about is just having a company costs a decent amount of money. And so if you relate that cash need to the size of the company's market cap, so say a company has a market cap of $20 million, but it costs them, just to have the company active, $500,000 a year just to keep it going. And then add on top of that, the project development. So if they're successful in finding a project, they're going to need more money because they'll need to advance it further. But if they're unsuccessful, if they do a drill program and don't get anything, they'll also need more money. So either way, they're gonna need money. And so as an investor, what you have to figure out is, can they create enough value to offset the dilution from the additional shares that are raised? And that depends, a little bit on the environment. In a few years ago when things were not doing very well, it was hard to get the value recognized. And so you could own the companies, and they could be good companies with good projects, but they're raising money. So, every time they go raise a little bit of money, you own a little less percentage wise of the company. Now we're getting into an area where specifically gold projects are getting recognized quite nicely now, where it's a little bit easier for them to create value because they get the recognition in the marketplace. But the dilution is a thing to keep in mind, because I've heard people, they'll look at a project and say, well, this project in production will generate so much cash flow, and that'll generate so much value per share. But what you got to keep in mind is, in order to get it from here to there, you may get diluted by half or more between here and there. So your actual interest will be a lot lower at that time once it's in production or gets acquired or whatever does happen to it.
Yeah, and just to dumb down a little bit further what you just said, because there's so much information right in there, which is so helpful to people, is that if a company raises capital, every time a company directly raises capital, the outstanding shares increases. So if you have 20 million shares outstanding and you go and do a raise, you could at the end of that raise end up with, let's say, 30 million shares outstanding. So if at 20 million shares you own 2% of the company, now all of a sudden at 30 million shares you own less than 2% of the company. But to the other point that you made, which is really important, is that ideally in a perfect world, when you get good results, the increase of the stock price, when you go to raise future capital, you're diluting less. So you're raising just as much money, but with the higher share price, it's less stock that you're issuing. So I think that's really important for people to understand, because the projects that you're looking at should be more long-term. Look at projects that you believe will have good results, that you believe have a long-term capability of moving forward on a go-forward basis, so that when the future rounds do have to happen, they will have to happen, that you're not getting diluted as much because the share price reflects it. But also, just that, keep in mind, you might want to invest yourself in future rounds. So when making those decisions, you want to partner up with the company and have that long-term approach, wouldn't you say?
Yeah, I would say yes, on the caveat that things are working as anticipated.
Yes.
So,
doesn't always happen in the mining sector.
So in investing in general, this is not specific to mining, there's a lot of luck involved, a lot of unforeseen events. We could have a global pandemic. We weren't thinking about that a little while ago, and things can happen that you don't anticipate. And so, even the greatest investors are still wrong a significant portion of the time. So I would say, when, yes, a long-term perspective is needed, but also if you realize that you're wrong, that's okay. So
Well, I think when if you realize you're wrong, that's why you need the professionals guiding you through this, because you don't always know when you're wrong, right? And that's where you need expert advice to tell you, maybe it's time to jump ship, right?
Yeah.
Or maybe it's time to just hold on a little bit. I believe in some of these results that have come through, and this is more of a market fluctuation as opposed to company fluctuation.
But I don't want to sound too negative on it. Your original question, I guess, was, in terms of being a long-term shareholder, and that's something to keep in mind, is how long these projects actually take to work out. Like from inception to production, could be a 15-year time horizon. And so there's a lot that's going to happen, between the initial startup until the project is sold or gets revalued significantly by the market. So it can, you have to have a lot of patience to be able to if the company is advancing the way you think it will, and the results are good, that process just takes a long time, and it feels like it takes a long time, and then looking back on it doesn't seem so long. But
well, and I think there's a really good point there to think about diversification. If you want a little bit of a mining portfolio, that you don't put all your eggs in one basket. Wouldn't you agree?
Oh, for sure. Yeah, I would say that the diversification, they say, is the only free lunch in investing. In that you don't necessarily sacrifice your return by being diversified. And I would say, so mining in and of itself is so cyclical that you want to have another portion of your portfolio devoted to other areas, maybe that are a little more stable, so that you can balance the cyclicality. So when things are down, you have the ability to invest more into them, and when they're up, you can sell and diversify. And then within mining, I think you want to be diversified across commodities, type of companies, whether they're early stage, advanced stage, and it really helps with the sleep at night factor, when you're broadly diversified. And it also helps with, I think if you're too concentrated in a position, you sometimes aren't that rational about.
Emotionally attached.
Yeah, you can get emotionally attached to it, and it can kind of disrupt, maybe what you should be doing with it. And so I'm a real advocate of diversification.
Okay, I want to get back to some of the form and function of securities as far as the mining sector. But while we're on this topic, let's talk about diversification. Can you talk to us about jurisdiction? Because that's a big part of investing in mining. You're not investing in one company that's based out of one location. So let's talk about jurisdiction.
Yeah, so the way to think about it is, there a lot of the safe jurisdictions, so developed countries, they're sort of the premium areas to find and explore for and own mining assets, because the risk of a significant change in government policy or change in government is less so than some of the developing countries that are considered a little riskier. So there's a example, a number of years ago, there was a huge gold deposit in Venezuela, one of the top deposits in the world that essentially got expropriated, and so the shareholders were left with nothing. So if you're going to other countries, you can invest there. There's certain countries in South America that are better than others, and it's okay. It's just you have to be compensated for the additional risk you might be taking. So, whereas in Canada, you essentially will get a premium valuation on a great asset in Canada in a mining friendly area. Whereas with these other countries, the valuation will be discounted potentially a little bit because of the country risk. So for a mining company to invest significant money in a riskier jurisdiction, they have to get a better return to compensate for that.
And I would imagine too that investing in Canadian mining is going to have some effect based on our new reality and the pandemic. I know some colleagues of mine who are in the exploration business, and when they get a team out to a location, they have to quarantine for 14 days. So that is housing people for 14 days with no work being done. There's also an additional risk to the team that you're in a jurisdiction that maybe you don't understand their healthcare system, you don't understand their political ecosystem, and you want the surety that we can get them home if there were to be an outbreak or whatever that may be. So there's a bunch of risks associated with that. Can you talk about how maybe you talked about a premium for Canada? Why does Canada have a bit of a premium? Why are we so great, Mark?
Yeah, good question. So Canada has a long history of mining and being favorable to mining. So it's actively encouraged by the government to develop mining assets, and some of the provinces in Canada are extremely supportive of it. And so that history combined with our ability to finance companies, because we have a large financial sector devoted to mining, helps us receive a premium valuation compared to some other jurisdictions in the world, and we're quite stable. Even the governments change and policies do change, but it's unusual for an asset to be taken away from a company because of government action. It can happen, but it is highly unusual, and so people feel secure in investing in the country. And if you're thinking gold as an example, if you're a gold investor, your reason for owning gold may have to do with some sort of bad economic situation or a pandemic potentially, and you want to be sure that the gold that you invested in is there in the event of that, and so you go to premium jurisdictions and you're willing to pay a little bit more to get that safety.
On that note, and I'm throwing you on the spot here a little bit, just out of curiosity, your
Mhm.
thoughts on it. Gold is doing quite well right now. Obviously, we're having this conversation in October of 2020. We've been on some form of lockdown since March of 2020. Any thoughts or maybe ideas of why is the price of gold directly correlated to the pandemic?
I think it's partially, I think it's also related to the government action in response to the pandemic. So they governments are running huge deficits in order to, get us through this thing, like very significant deficits that would, we wouldn't have contemplated a few years ago that they would be this large. And the central banks are through quantitative easing, printing the money to fund these deficits. And so if you look at your alternatives, as far as a safe investment, take a government bond, the yields on them, pretty much across the board are below inflation levels. So your real after inflation, after tax rate of return on government bonds is now negative. It's certain that you'll get that, but it's negative. And so I think a lot of investors, maybe that weren't specialists in the gold space, but were general investors. I said, I think this gold as an investment, as investment, provides protection from inflation. And so, it's maybe a little more appealing to have some gold in, when compared to, some treasury bonds that are, going to guarantee you a negative return over the next while on a after inflation, after tax basis.
Well, and I think it's important to note too, the trickle down effect of good gold prices is directly correlated to even exploration, because if it costs you more to remove ore or gold from the ground than it does to sell it, there's not much of a business model there. So when there's some actual margins involved in the cost of exploration and discovery and extraction, to be able to actually sell and create some margins, then it trickles all the way down, which is great for a market. And I was chuckling a little bit earlier when you said that in 2005 it was great, and I think a great market just gets everyone excited and jazzed about it. And the mining sector, we really have taken a long sleepy rest, a little hibernation period. So I think everyone I talked to is pretty excited because we're finally starting to see stuff happen. And the great thing about when stuff starts to happen is not just the discoveries, is not just the share prices and the upside, is the infrastructure that gets built around it, the technology that starts getting created, the jobs that get created, just the trickle down effect is quite amazing to see when we have a good mining market. And I think too, a lot of people don't realize that everything we touch on a day-to-day basis, other than what we eat, is from a mine in some way, shape, or form. We rely on it so heavily that it's a part of our society, ingrained more than people mainly realize. The one thing I want to go back to a little bit is again coming to the investment side. The other thing that Canada offers is some potential benefits to investing in the mining space. So can you touch on that a little bit?
Yeah, so companies doing exploration, the government allows, because these companies are pre-revenue, they don't earn profits, their expenses basically are not deducted against offsetting income for the most part. So the government allows them to actually flow through their exploration expenditure, provided it's in Canada, to the investors. They offer what are called flow-through shares, and there's a little different rules in different provinces in terms of how they work, but essentially you get a tax write-off for the expenditure that the company expended on exploration, and then the companies offer these shares in the market to investors. So it really depends a little bit on your tax bracket and the particular province that the exploration is happening in. but our crude way of thinking about it is, you invest in one of these flow through shares, and your at risk capital, because of the tax benefits, is roughly 50 cents on the dollar, and so the investors can participate either directly in flow through share offerings that the companies offer, and these are typically offered to accredited investors, which there's some restrictions on who qualifies as an accredited investor. And if you're not an accredited investor, or you want to maybe just have a diversified approach, there are a number of flow through limited partnerships, which are essentially like investment funds of flow through shares, where you get a tax write-off. It's a neat opportunity for Canadians, because once you've maxed out your RSP contribution, there's not a lot of other things you can do to reduce your tax burden. So it's a neat way of playing the sector by reducing your risk a little bit on the way in. But still, you still have an investment, though. That's the one thing to keep in mind. So, the way I look at flow through shares is I would buy a flow through share, but only in companies I would invest in otherwise, because at the end of the day, that's what you are putting your money into, is shares in that company. But it's a really powerful tool offered just to Canadians. So.
That's a really great point. So that is a takeaway, I think, for people, is don't do a flow through share just because it's a flow through. At least still pick a company that you intend to invest in anyway. And the other part of the flow through that I really like, and look, there is a cost associated with being a public company. It's there's costs with auditors and legal counsel and transfer agents and your exchange fees as well. Luckily, our exchange is so valuable.
Your fees are lower than
our fees are way lower than anyone else. So that's my only CSE pitch for this talk. But I think the other thing is you get the opportunity to ensure that the funds that you're sending are going into the property, which is a nice opportunity as well. And these companies need to survive. They need to pay for their expertise and technical team and being public and everything else. They need to pay the people to help them raise money. So there's lots of costs, but it's also nice, this opportunity every once in a while to write a check and know that it's actually going into the property and furthering the development of that property. So that, that's a neat opportunity as well. You brought up something else I thought was, I think is great to touch on, and this is all sectors, but in the mining sector, we see a lot of private placements. Can you maybe touch on, I don't know if everyone understands that when you buy on the stock market, you're actually buying a stock from a seller. You're not investing into the company. So a company needs to actually complete a financing where you write a check directly to the company for that money to actually go into the treasury of the company for execution of a drill program or for the forwarding of their business. So can you talk a little bit about the private placements that we hear lots about and we see lots in the mining sector, and how that works?
Yeah, so that's a good point. So everything on the stock market, for the most part, the trading you see is what's called the secondary market. So these are shares that were previously issued that you're buying from another investor, or if in a selling case, you're selling to another investor. And that's the secondary market. New issues are how companies raise money. So, typically IPOs are investment into the company. But in the mining space, most of the money raised is done in the form of private placements, at least for the earlier stage companies. And that's because a public offering through a prospectus is just a little bit more of a burdensome process for the issuer. And so a private placement is available to accredited investors. The rules on accredited investors, there's some net worth tests and a number of other categories that allow you to qualify as an accredited investor. I'd recommend discussing with an investment advisor whether you qualify as an accredited investor. Generally, the one rule that most people qualify under is either through having a certain net worth or a certain annual income. But that's how most of the money is raised, is through these private placements. And, some of the neat opportunities to come with the private placements is a lot of the private placements on the smaller companies include warrants. And that's an added benefit to participate.
Sweeteners.
Yeah, so it's essentially a warrant, is like a stock option. So you hear about, CEOs getting stock options or employees of some company getting stock options for working there. Well, warrant is kind of like a stock option that you get as an investor for investing in this particular offering, if they include warrants. And what that can do is enhance your return if the project works out. So if you say bought a share that at a certain price and included also a warrant at another price, if the stock went up a bunch, you could make money from the share appreciation, but also that stock option, the warrant that you received.
You lock in a price, right?
Yeah, at a specific price. So, example would be say a stock they were issuing shares at $1, but also included a warrant at $1.50. And so if the shares went from $1 to $2, you would make money from the increase of the shares you purchased from $1 to $2. But the warrant also has some value because you received the right to purchase shares at $1.50. So if it goes to $2, you also made 50 cents on the warrant as well. So it's they're interesting opportunities, and these are purchased directly from the issuers typically.
One other question I have for you, I really am testing your knowledge today. There is also a existing shareholder exemption. Is that right? Did I say it right? So it's existing shareholder exemption. Can you tell us about that?
Yeah, so there's a number of exemptions. I was discussing the accredited investor exemption, but there's a number of different exemptions that companies can use to raise capital from investors. And what the exemption refers to is essentially an exemption from a public offering or prospectus requirement. And so existing shareholder is another exemption. Now the company has to specify in their offering documents that they're relying on this exemption, but that's an exemption where if you are already a shareholder of a company and there's an offering that comes out, you can participate in that offering without necessarily being an accredited investor. But this is provided the company is relying on that exemption to sell you the newly issued shares. But that's something I think that's a more recent exemption that is essentially been put in place in part to democratize the participation in this industry, so that you didn't necessarily have to have a certain net worth test to participate in a new issue on early stage companies.
I'm a big fan of it, and I think it's trending in the right direction. Unfortunately, the accredited investor exemption, it only allows people with a certain net worth to be able to participate directly in the companies. Whereas if you have a brokerage account, then you can go and buy whatever company you want. It's nice to be able to invest directly into the company. So I think that's another takeaway for people, that if you like a company, if you like the management team, if you like the property, you can go and buy it on the open market. And once you're a shareholder, I think there's some restrictions about how much you can buy, but if you like a company and you want to participate in that regard, become an investor, and when that opportunity comes down the road for them to raise capital again, that you can participate in that way. So I don't know how widely used it is, but it's also something that people should look into, because I think it's an opportunity that opens some doors. Hopefully, our regulators continue to open those doors for people to participate, obviously in a safe and manageable way for people, but I hope that we can continue to open those doors for people to participate. Listen, Mark, I feel like I could talk to you forever about this. We might even have to have a part 2, a part 2. The one thing I want to touch on before we go is, let's talk about Central Canada. Is there some great projects going on? You talked about potash. I know potash is a big part of it, but maybe we could just send off with your thoughts on Central Canada.
So I'm in Saskatchewan. So there's 2 main commodities that are mined in Saskatchewan. There's other commodities as well, but it's potash and uranium. So Saskatchewan and actually parts of Manitoba, although they're not in production, has a sedimentary basin with that's essentially a salt layer that has huge potash reserves. So that's represents about 50% of the world's potash reserves. And then in northern Saskatchewan, there's what's called the Athabasca Basin. And actually it does extend into other provinces, but it contains the world's largest uranium reserves, about 20-30% of the world's uranium deposits, with the rest being in Kazakhstan mainly. But the uranium deposits are some of the richest ore bodies of any type of mine out there. Like the grades on them, if you think the uranium price might be, say it's $30. I don't know what it is right now, but the grade could be 20% uranium. So if you were to think of it, you would never hit 20% copper, as far as a mine, but they're technically challenging to extract, but they are some of the richest ore bodies. And then there's gold potential too. There's a CB gold mine that has been in production for quite a while now and produced over 1 million ounces, and some base metals as well. Manitoba has significant base metal potential with some, Hudbay mining has always had some pretty good mines there, and there's also gold opportunities in Manitoba as well. So it's really got some really unique assets. But I would say that if the number one exploration opportunity probably would be in the uranium space. They're extremely hard to find, but when you hit a significant ore body, the leverage to the upside is pretty significant. And so that's, I would say, is probably most of what happens in Saskatchewan is the uranium exploration. And it's a really risky kind of area, but the upside is so huge once you hit a significant deposit. Potash is, it's not hard to find. It's more of a logistic challenge to get out.
Yeah.
So that's a few of them.
Well, we're also going to be hosting this week during Central Canada Week. I have the opportunity to host Gwen Preston, who is with Resource Maven, and we're going to be talking specifically about uranium in Central Canada. So for anyone watching this, make sure you check out that clip as well, because we'll dive deep into the uranium side in Central Canada. Do you think that the landscape lends a little bit to facilitate these opportunities? It's a little bit easier to, I don't want to offend you by talking about how flat it is where you are, but does that lend a little bit to the ease of exploration and mining?
In terms of just the topography of Saskatchewan, you mean? Yeah, the Saskatchewan is pretty flat, so you're not walking up mountains to get into things. Now the Athabasca Basin that is fairly remote, but there's lots of mining activity. There's lots of back and forth that get people up there pretty easily. There's all sorts of flying services that can get you to your property. There's even some roads. I would say it probably is one of the easier areas on Earth to explore, and it's still probably underexplored than probably it deserves to be. So I still think there's a lot of potential, and the exploration is probably fairly cost effective too. Compared to some other parts of the world.
Those are all valuable things when you're looking to invest in a company. Mark, I can't thank you enough. This was a great chat. I'm such a geek. I love talking about this stuff. I can talk about it all day. So we might have to do a part 2, but thank you again for your time. And hopefully it doesn't get too cold out there for you this winter. And
I had to start my car this morning and let it warm up. So it was minus 13 last night or something like that.
Okay, that's cold. That's cold. Well, listen, stay warm and stay safe and healthy through through COVID and what we're all going through. And thank you again for all your assistance today.
You too. Thanks a lot, Anna.